Rajesh Kothari, Managing Director of AlfAccurate Advisors, on the show now. Rajesh, the big question is, after this print on the markets, where are we headed from here on? Are we likely to pause, consolidate along these levels for some more time, or do you see significant upside? Does it make sense to buy at these levels?
Well, I think it is just, if you ask my personal view, volatility, of course, will remain, and consolidation and everything will continue like as usual every time. But if you look at last 10 years, market has delivered what, about 12-13% compounded returns. If you look at last 5 years, again, it is 12 to 14% compounded returns. So it is not that, market is significantly overvalued. I don't think so. Markets are not cheap, but it is not expensive either. And people who are just waiting on fans, hoping for a correction, I think probably market is going to throw more surprises to them. So don't wait too much. I think there are a long runway ahead. I think it is the beginning of the earnings growth cycle after a very long time. The capex is going to move up. The non-food credit growth is already reflecting the initial signs of improvement. So I think the best is yet to come. And this asset class will keep delivering 12-15% compound returns for the long-term investors.
Well, we take that point, Rajesh. I was looking at a couple of these names. Laurus Labs, of course, Nimesh pointed out in the standout brokerage that we had a downgrade coming in from Kotak Institutional Equities. That stock makes lows of the day right now as we speak. Indian Hotels is the other one. This afternoon we were speaking with Quantum, and they said that they have exited their position in a large hospitality company. Looks like this could be one because it's down about 10% from its highs. We had ABB India currently at the low point of trade, and Nippon as well, which is currently at the low point of trade. So a bunch of stocks actually. Prashant spotted, the advanced decline line, saying that both of them have merged. Now it turns out that the declines have been higher than advances, and as a result of which the Nifty too has declined from highs, currently sitting with a gain of just around 70 odd points. So Rajesh, your thoughts on a lot of these individual names which have done well in the past? Indian Hotels, case in point, but now people are finding it expensive at these valuations, especially after the run-up.
Well, we are not holding that name, so it won't be good on my part to comment on it. But if you ask me, if you look at the overall economy growth, I think what is more important is look at the data points, right? And if you look at the GST collection, it is a 3-year compounded growth of 17% for the country. If you look at the the electricity demand is very strong. If you look at the non-food credit growth is very strong. If you are going out and if you are looking for a good hotel room, probably you have to pay 20% high, particularly in weekends. If you go to airports, it is a pretty jam airports. And of course, there is no space to walk on the roads. So economy is doing extremely well. The short-term volatility, the day in, out, the up, down, all these things are part of equity market. So don't worry too much about it. Get invested in the best asset class, get invested in the best asset quality, the right companies and right business models. That's what basically will ultimately create wealth, correct? So, notwithstanding the short-term corrections, if any, that's fine. But we are very bullish on capital goods. We are very bullish on banking and finance. We are very bullish on automobile and auto ancillaries. And also we are very bullish on specialty chemical as a theme. So these are the 4 sectors on which we are kind of what I would say, overweight, from sector allocation perspective. And I think probably there is a huge long runway ahead for these sectors to continue to perform even from current valuations.
No, this well put, and it's gotten to a point, Rajesh, where luxury car companies are complaining about SIPs and saying, well, that's the reason why car sales are down.
True.
That was quite something. Rajesh, stay with us. Another one of these names is National Insurance. That's the general insurer. If you can put this up, the code is NIACL, and it's up 14%. Right now, 13-14% right now. And if there is ever a name which kind of exemplifies underperformance, this is that. I mean, it's a government insurer, only does general insurance. I don't know if you found the name. It's National Assurance, and we'll have it up at 115. It trades at 115, 116 rupees. Listed at what? 2017, November of 2017. And you can actually count the number of up months that it has had over the last, 4 years 4.5 years or so, just a handful. I mean, you can count them on, one hand. It's just been a journey southwards and southwards and southwards. And today, for some reason, it is seeing a big move higher. Rajesh, names like Bandhan, which I don't know if you heard, my colleague Vivek outlined, CLSA seen an upgrade. That's been a huge underperformer. You're seeing this move in national assurance, but there are also other huge laggards, right, which are starting to come up. Is this the market trying to, pick value where there is left? Maybe, one doesn't know if there is value, but there is underperformance, huge underperformance in some of these names. So betting on turnarounds, because what is doing well is appropriately valued in that sense. Go on.
Well, I think, what is very important is to look at the value only if there is a sustainable growth underlying that value. Because if that sustainable growth and that capital discipline, which is defined by return on capital employed, if these two pillars are missing, then it is going to be a trap. And that's why people always say globally that value is a trap, right? Because value, there is always a cap on upside. So if you buy something at 0.2 price to book, you sell it at 0.4 price to book. So it means you need to get out. If you don't, then it becomes a problem because there is no underlying earnings growth. So you need to be very, very careful. I completely agree with your point that, globally as well as in India, there are many companies which do not have the solid fundamentals. They might have the fractured balance sheets. They might have zero cash flow conversion, and still you see the stocks going up 100, 200%. Possible, but it is never sustainable. That's not the right way, to create the wealth. That's basically momentum. In typical parlance, it is called, satta market, correct? But if you want to be really into the business of serious wealth creation, then you need to be into the companies with right business models, right balance sheet, and of course, right earnings growth. So that doesn't mean you avoid, all companies which are just called value. That doesn't mean that. If you think there is a growth in that value stocks backed by the good companies, for example, PSU banks. So we own PSU banks in our portfolio, So because we believe that there is going to be a strong, NII growth, there is going to be, reduction in slippage, there is going to be reduction in credit cost, there is going to be reduction in provisions. So your return on net worth will improve for public sector banks, which was not the case for 5 years, correct? So now we are holding even public sector banks. So we are not, one should not say, I will not buy into a particular class just because it is PSU or private. Important is underlying ROE with the better earnings growth quality. And if that is coming, then you should not be, averse to investing into the same.
Rajesh, it's a pleasure. Thank you very much for joining us. Appreciate your time here on CNBC TV18, as always. Thank you very much. Well, time for a quick commercial break here. A very interesting conversation coming